Given that this is our first call of the year and it is July, I just wanted to take a moment and talk about a few of the more notable financial things that have happened so far this year, just as sort of a reminder or a recap. And certainly, my list isn't going to be exhaustive. I'm sure I'll leave out some important topics. But as I was thinking about this call and joining everyone this morning, these were some of the items that stood out to me. And starting in the beginning of the year in January, we saw China reopen its borders and loosen travel restrictions for the first time in 3 years after COVID lockdowns. And China being the second largest economy in the world, has a significant impact. And really, the hope was that China coming back online would really be a boost to global economic growth. And we'll be hearing more about that in the Q&A section of this call. In February, we saw the first Fed rate hike of 2023. Certainly, we saw more. We saw them in 2022 as well, but February was the first in 2023. We've had three Fed rate hikes so far this year, each of them being 25 basis points or 0.25%. The Fed funds rate is now just north of 5%, which is the highest it's been in about 16 years. And as we all know, this rate impacts the rates we pay on things like our mortgage, auto loans, other consumer loans. It also impacts what we earn on our cash and cash equivalents like money markets and other short-term debt instruments like treasury bills. In March, we saw three major banks fail. We saw Silicon Valley Bank, Signature Bank, and First Republic fail, and this was the first time since the Great Financial Crisis in 2008 that we had three major banks fail. And certainly there were unique circumstances around those failures, but at the time there was much concern over the potential for contagion or run on banks. There was a hard look at FDIC insurance and also the potential moral hazard that can be created through bank bailouts. And we'll certainly hear more about banks and sort of the health of banks and potential regulatory changes because of those failures in the Q&A section as well. So while rates were rising and banks were failing, we also had a strong labor market, and there were over 1.5 million, close to 1.7 million jobs added in the US economy in the first half of 2023. And we've seen a pretty strong consumer in the first half of 2023, and the jobs market or the unemployment number is low, unemployment is high, and that's helping the consumer stay strong. We've seen wages continue to grow, albeit at a slower pace than in 2022. And consumer spending makes up about 70% of the US economy. So we're employed, we feel like we have more money in our pocket and we're going out to spend, and that's certainly contributed to economic conditions in the first half of this year. No recap of the first half would be complete without a mention of the debt ceiling, which we had the debt ceiling crisis in May and the first few days of June. As it always has happened, or at least historically so, this was resolved in the 11th and a half hour. Default was averted, which was always the base case, but certainly some heart palpitations were felt as we came up to that deadline. And then most recently, meaning just yesterday, we got consumer price information for the month of June. So the consumer price index is a way that the government measures inflation by looking at the prices of a basket of goods. And the CPI number we got yesterday for June was about 3%. So the prices for that basket of goods were higher this June by 3% than they were in June of 2022. This is the lowest CPI rating we've had since, I believe, 2021. And it just speaks to the trend of lower inflation that we've seen over the course of this year. And you'll certainly hear more about that from our panel as well in the question and answer section.